It hit me on a Tuesday morning. My screen lit up, numbers moving. Not a crash, not a spike, just a flicker. But it was enough to make me sit back, stare. Something was off. You might not see it, and most people won't. Not on CNBC, not in the headlines. It's underneath, subtle, quiet. The kind of thing that doesn't make a ticker scroll, but moves billions. Gold feels it already. Silver? Silver is about to. And it has nothing to do with what you read yesterday about inflation, or interest rates, or the big Fed announcement everyone's waiting for. Those are the surface. This is under it, beneath it, the pressure building in silence for 4 years. You pick up your phone, swipe past news alerts, check the weather. Your thumb pauses over the financial tab. That's the moment you realize the world is shifting before your eyes, and it doesn't wait for consent. This isn't hype, not fear, just facts speaking softly to those willing to listen. And right now, that's you. You notice. You're the one staring at the screen a second longer, the one who asks, what's really happening? Markets don't fear bad news. They fear what most people haven't noticed yet. Over the last week, the Federal Reserve maintained its benchmark interest rate at 5.25 to 5.50%. This decision follows a similar stance from the previous meeting. No cut, no increase, steady. The latest Consumer Price Index, CPI report shows annual headline inflation at 2.4%. Core inflation, excluding food and energy, remained at 5.3% year over year. These figures are consistent with the past 2 months, which saw minor fluctuations of 0.1 to 0.2 percentage points. Treasury yields responded with subtle movements. The 10-year note rose from 3.95% to 4.01% over 3 trading sessions. The 2-year note held near 4.85%, shifting less than 10 basis points. Trading volumes on government securities were near the 30-day average, indicating moderate liquidity. Gold prices fluctuated between $1,965 and $1,985 per ounce over the same period, closing near the midpoint. Silver traded between $23.70 and $24.10 per ounce. Both metals experienced intraday volatility of approximately 1 to 1.5%, in line with recent averages. Global silver supply data shows continued constraints. According to the Silver Institute's 2025 annual report, industrial demand reached 680 million ounces, surpassing mine production and recycling by approximately 20 million ounces, marking a 4th consecutive year of structural deficit. The United States finalized silver on the critical minerals list in late 2025, classifying it alongside materials deemed essential for national security and industrial infrastructure. This designation is publicly documented by the U.S. Department of the Interior. Meanwhile, major industrial sectors, solar energy, electric vehicles, advanced data centers, and defense manufacturing continue planned expansions. Publicly filed reports from leading solar and EV producers confirm ongoing procurement of silver for 2026 production schedules. In summary, the past week's events maintain continuity with a 4-year trend. Fed policy steady, inflation persistent, hard asset markets experiencing moderate volatility, and industrial demand for silver outpacing supply. There were no dramatic shocks, only incremental movements aligned with longer-term patterns observed by financial institutions and government reports. When the Federal Reserve holds rates steady while inflation remains persistent, the immediate effect is subtle but widespread. Borrowing costs for consumers and businesses remain elevated. Mortgages, corporate loans, and credit lines do not suddenly become cheaper. That alone slows discretionary spending, impacting sectors like real estate, durable goods, and consumer services. For gold, stability in rates combined with persistent inflation sustains interest from investors seeking a hedge. Higher rates typically make non-yielding assets less attractive, but when inflation continues, the real return on cash and bonds remains uncertain. This keeps gold in demand, not as speculation, but as a defensive asset. Silver responds similarly in the short term, though with an added layer: industrial usage. Industrial consumers of silver, solar panel manufacturers, electric vehicle producers, data centers, and defense contractors face constraints. When supply lags demand, procurement costs rise. Companies may adjust production timelines or hedge forward contracts, subtly influencing commodity markets before prices fully react. This is a first-order effect, tangible operational shifts that ripple through supply chains. Second-order effects emerge as financial and institutional investors respond. Seeing consistent industrial demand combined with constrained supply, funds adjust allocation strategies. Lease rates on physical silver can spike. Spreads between spot and futures prices may widen. These are signals that professional observers track closely. Unlike headline-driven market reactions, they reflect deeper pressures. Furthermore, silver's designation as a critical mineral adds a strategic dimension. Governments and large industrial buyers anticipate long-term constraints. Purchasing decisions may accelerate to secure supply before competitors do. The market begins to bifurcate. One side oriented around financial speculation, the other around industrial necessity. The convergence of these forces amplifies market sensitivity to small shifts in production or policy. For everyday investors, the relevance is not immediate panic, but understanding the layers of influence. Monetary policy affects financing and opportunity cost. Industrial demand affects real supply and operational constraints. Regulatory classification affects strategic behavior of large players. Together, they create a complex system where small changes can propagate quickly. Even without dramatic price swings, these conditions influence portfolio positioning, risk management, and timing decisions. An investor who considers only surface-level headlines may miss subtle pressure building across multiple dimensions. Those tracking both monetary signals and industrial trends can anticipate potential shifts and position accordingly, rather than reacting after a visible price move. In short, persistence in inflation plus stable rates shapes borrowing and investment decisions. Constrained silver supply combined with strategic demand creates a layered, interconnected pressure system. The chain reaction is quiet but cumulative, affecting both the financial and industrial sides of the market simultaneously. Looking back, the last time silver experienced sustained structural deficits alongside elevated industrial demand was the mid-2000s. Between 2014 and 2016, global silver production lagged slightly behind industrial consumption. Solar expansion and electronics growth created upward pressure on physical supply. Prices responded with moderate spikes, but the market absorbed most of the imbalance through stockpiles and leasing mechanisms. At the same time, interest rates were slowly rising. The Federal Reserve had started tightening in 2015 after a prolonged low-rate period. Investors in gold and silver were balancing yield opportunities in fixed income against hedging against persistent inflation signals. Market movements were visible, but gradual. No single event triggered an immediate surge. Comparing then to now, a few distinctions are clear. Today, the industrial pull on silver is broader and deeper. Solar, EV, AI, data centers, and defense sectors simultaneously exert demand, unlike the more isolated growth sectors of the mid-2000s. 4 consecutive years of a structural deficit create a cumulative pressure that wasn't present before. Regulatory context also differs. Previously, silver was not designated as a critical mineral in the U.S. Today, this classification elevates the strategic importance, influencing procurement decisions by both industry and government. Stockpiles and futures markets may respond more aggressively because large buyers now treat silver as essential, not optional. Finally, the monetary backdrop is not identical. Mid-2010s tightening was gradual and widely anticipated. Current Fed policy holds rates at a restrictive level, while inflation remains sticky, not collapsing, not surging. This creates a window of uncertainty in real yields that interacts with physical demand differently than before. The lesson from history: deficits in industrial demand can create pressure, but context shapes how it manifests. Markets adjust over time, but cumulative forces, regulatory attention, and concurrent monetary conditions determine speed and intensity. Patterns may echo past scenarios, yet the combination of today's industrial breadth, policy stance, and strategic designation creates a scenario that is familiar in structure but unique in its composition. History doesn't predict outcomes. It filters emotion and perspective. By examining past instances, investors see how similar conditions unfolded, how supply shortages nudged industrial buyers, how hedging behavior influenced pricing, But also recognize that the interplay of forces today introduces variables not present before. Bull case. If industrial demand continues at its current pace while supply remains constrained, silver could experience a sharper upward pressure. Imagine solar and EV production accelerating faster than expected, and manufacturers locking in forward contracts. If the Federal Reserve begins signaling a pivot, slightly easing rates in response to slowing growth or persistent labor softness, capital could flow into hard assets. In that scenario, gold would likely see modest gains first, followed by silver, which carries the additional industrial pull. Structural deficits compounded with strategic purchasing could create a convergence, where both monetary and industrial forces push the price upwards simultaneously. Even a modest release of stockpiles would likely absorb only a fraction of this pressure, leaving market participants scrambling for physical silver. Base case. If supply and demand maintain their current trajectory without sudden shocks, silver may continue a pattern of measured volatility. Prices would fluctuate within ranges consistent with historical supply deficits, influenced by monthly production and recycling levels. Monetary policy holds steady, inflation remains persistent but controlled, and industrial buyers continue regular procurement. In this scenario, investors might see minor spikes in leasing costs or spreads between spot and futures prices, signaling tightening without dramatic movement. The market reacts quietly. First-order effects impact industrial buyers. Slightly higher input costs, minor adjustments in production schedules. Second-order effects manifest for funds and hedge positions. Subtle portfolio rebalancing, incremental shifts in forward contracts. Growth sectors continue expansion, but no single factor triggers a dramatic repricing. The convergence of forces exists but remains contained, giving observant participants a chance to adjust gradually. Bear case. If a significant event disrupts either supply or demand unexpectedly, the trend could reverse. For example, a sharp slowdown in industrial production, delays in government-backed energy or EV projects, or a sudden increase in mining output could ease physical pressures. Likewise, if monetary policy tightens aggressively to combat inflation, or unexpected economic data shifts expectations for real rates upward, non-yielding assets could lose relative appeal. In that case, silver's price might stagnate or even decline despite underlying deficits. First-order effects appear in industrial budgets. Procurement can pause, contracts renegotiate. Second-order effects ripple through speculative positions, lease rates normalize, spreads tighten. The market resets to a lower equilibrium, highlighting how interdependent forces, industrial demand, supply, and monetary signals, must align to sustain upward momentum. Across all scenarios, the guiding principle is conditional. None of these outcomes is guaranteed. The interplay of Fed policy, inflation persistence, industrial growth, and regulatory action determines how each scenario might unfold. Observers must track multiple indicators simultaneously, recognizing that convergence amplifies movement when it occurs, but that absence of alignment may mute otherwise obvious trends. Right now, my attention is split across a few things that really matter. First, the US dollar index, the DXY. It's not just a number. It tells me how international capital views the dollar compared to other major currencies. When the dollar strengthens, non-yielding assets like gold and silver feel that pressure immediately. Weaken slightly, and suddenly those same metals gain relative appeal. Next, Treasury yields. Not just the 10-year, but the 2-year and 5-year too. The shape of the yield curve whispers about expectations. If short-term rates stay high while longer-term yields ease, that tells me the market anticipates a slowdown, maybe even a pivot by the Fed down the road. It doesn't always happen on a Fed schedule. Markets often move first. Inflation data is another lens. CPI, PCE, especially core measures that strip out energy and food. They are like a thermometer, not a yes/no signal, but a reading of pressure. Persistent readings in the mid-2s for headline inflation, or small nudges higher in core, keep the central bank cautious. That caution is what keeps gold and silver in play as hedges and silver as an industrial hedge simultaneously. Volume and liquidity tell me how much real money is actually moving. Look at open interest in futures. Look at lease rates for physical silver. If spreads start to widen or lease rates spike unexpectedly, it's a signal that something beneath the surface is tighter than it appears. It's subtle, but it's real. Finally, industrial sourcing signals. Public filings from solar companies, EV manufacturers, and defense contractors. When they start locking in long-term contracts or expanding orders for physical silver, it's a structural nudge, not speculation, a confirmed demand push. I'm not watching social media hype. I'm watching the plumbing, the signals that show up first in numbers, in spreads, in behavior, not in headlines. If you follow those, you see the undercurrent. If you ignore them, you only notice the wake after it passes. So what's the takeaway? Nothing flashy, no dramatic call to action, just this. The forces shaping gold and silver are quiet, layered, and persistent. Monetary signals, industrial demand, supply constraints, they are all moving at the same time, often unseen. Your position, if you hold these assets, sits at the intersection of these forces. Timing matters, awareness matters, but panic doesn't. Observing, understanding, and patience do. Markets have a way of testing who is paying attention. They don't announce lessons in advance. They simply move, and those prepared recognize it early. This isn't investment advice, it's simply how I'm reading the market right now. Track the indicators. Notice the subtle shifts. Be aware of converging forces. And above all, manage risk. Stay disciplined. Wait for clarity before assuming certainty. The pressure is there. The signals are there. What happens next? That's still for the market to show.